All right, let's dive right in. Today, we're talking about a financial tool that's all about putting you in control. Universal life insurance. So if you've ever felt like your insurance plan was a bit too rigid, a little too one-size-fits-all, then you're going to want to hear this.
You know that feeling, right? With a lot of traditional insurance policies like whole life, it's like this: you put your premium payments in, and you're promised that someday a death benefit will come out. But what's happening in between? For most people, it's a complete mystery. It's just a black box where you have almost no say and even less visibility.
Well, Universal Life, or UL, was created to crack that black box wide open. On the left, you've got your traditional policy. Everything's bundled together, it's rigid, it's opaque. But UL on the right unbundles all those pieces. It swaps rigidity for flexibility and opacity for transparency. And here's the kicker: you get to see exactly what's going on inside your policy. So how does all this flexibility actually work? Well, it all comes down to the flow of your money. See, Universal Life takes the three main parts of a policy that are normally all mushed together, and it separates them. So let's break them down one by one. First up, you have the cost of insurance, or COI. This is the pure, no-frills cost of protection. It's what the insurance company charges to cover the risk that they'll have to pay out the death benefit. The key here is that in a UL policy, this number isn't some hidden secret. It's right there in black and white for you to see. Second, you've got the policy expenses. You can think of these as the admin fees, the cost to keep the lights on, to manage all the paperwork, and handle all that background stuff. And just like the cost of insurance, these expenses are transparent. And number three is the heart of the whole policy, the investment account. This is the engine that drives everything. Every premium payment you make goes directly into this account. And it's from this account that the cost of insurance and those expenses get paid. And the best part? Whatever is left over has the potential to grow tax-sheltered. This diagram shows you exactly how that engine works. Your premium payment comes in at the top and goes straight into that investment account right in the middle. From that central hub, the insurance costs and policy expenses are paid out. But here's the cool part: any investment returns get added right back in, creating this cycle that can really grow your policy's value over time. So really, it's a pretty simple four-step loop. 1, you deposit your premium. 2, the costs are taken out. 3, any investment returns get added back. And 4, you have a new cash value. This cycle, just happening over and over again, is where the policy's power really comes from. Okay, so that's the theory. But what does this control actually look like in the real world? Let's walk through a couple of examples to see this flexibility in action. So this is Elaine. She's got a universal life policy, she's been paying her premiums, and everything's going smoothly. But a pretty big life event is just around the corner. Elaine is expecting a baby and is about to go on maternity leave. That's amazing news, but it also means her income is going to be a lot lower for a while. Now, with a traditional, rigid policy, that fixed premium could become a real financial burden. But with Universal Life, she's got options. Because she's been paying $500 a month and has built up a cash value of $2,900, she is in the driver's seat. She can choose to pay only the minimum premium to keep the policy active. She could pay a reduced amount that fits her new budget. Or she could even stop paying premiums altogether for a few months and just let the cash value she's already built up cover the policy's costs. That right there is a perfect example of flexibility when life happens. Okay, now let's look at a totally different scenario. This is Richard. His family is also about to go through a big change, but his needs are kind of the opposite of Elaine's. Richard started his universal life policy with $500,000 in coverage, and at the time, that felt like more than enough to protect his wife and 2 kids. But life threw them a wonderful curveball. They found out they're expecting twins. Suddenly, their financial protection needs have pretty much doubled. With a traditional policy, he might have to go out and buy a whole new, separate one. But not with UL. After providing some updated medical information, Richard was able to increase the death benefit on his existing policy all the way up to $1 million. He just adapted his coverage to match his new reality, all within the same flexible plan. So as you can see, this flexibility is incredibly powerful. But that power doesn't come for free. There's a catch. With Universal Life, you are not just a passenger, you are the pilot. On one side, you have all this power. You can control your premium payments to match your cash flow. You can adjust your coverage up or down as your life changes. And you have the potential for your money to grow inside a tax-sheltered investment account, which is huge. But on the other side of that coin, you're the one managing the risk. If you stop paying premiums and your cash value eventually runs out, your policy could actually lapse. It could disappear. If the investments inside the policy perform poorly, it could hurt the long-term health of your plan. This is not a set it and forget it kind of product. It really requires you to pay attention.
You know what they say, with great flexibility comes great responsibility. Universal life insurance puts the controls squarely in your hands, offering a level of customization that's pretty much unmatched. So the final question is really a personal one. Are you ready to take the wheel?